Secured credit cards. Think of this as the training wheels of credit. You give the bank a cash deposit, say $300, and they give you a credit card with a $300 limit. If you don't pay, they just keep your deposit. No risk to them, which means almost anyone can get approved even with zero credit history or a wrecked score. These exist for one reason: to give you a low-stakes way to prove you're trustworthy, so the bank will eventually trust you with real, unsecured credit. Boring? Yes, but boring is exactly how you build a credit score that doesn't embarrass you later. Credit builder cards. A close cousin of the secured card, but with a twist. Instead of a lump sum deposit, some of these work more like a savings plan. You make small payments that get locked away, and the limit is tied to that growing balance. Functionally, it's the same goal: turn no credit history into some credit history, just with a slightly different mechanic depending on the issuer. Same training wheels, different bike. Student credit cards. Same idea, different audience. Banks know college students have basically no income and no credit history. But they also know that an 18-year-old today could be a 35-year-old with a mortgage, a car loan, and a six-figure salary. So banks plant the flag early. Lower limits, easier approval, sometimes a small cashback gimmick to keep you loyal. It's basically the bank saying, we'll take a small risk on you now so we can make a bigger profit off you for the next 40 years. Standard unsecured credit card. This is the baseline default credit card. No deposit required, decent limits, decent interest rates, usually somewhere in the high teens to mid-20% APR. This is the card most adults end up with once they've built some credit history. Here's the catch, and this is where most people go wrong. This card doesn't do anything special. It's neutral. Whether it becomes a useful tool or a slow-motion financial disaster depends entirely on whether you pay it off in full every month. Cashback cards. Now we start getting into the fun cards, the ones that pay you for spending money. Cashback cards give you a small percentage back, usually 1 to 5%, on purchases. Sounds great, right? Free money for buying groceries? Here's the twist. That cashback isn't coming out of the bank's generosity budget. It's coming out of a fee the bank charges the store every time you swipe, called an interchange fee. The bank takes a slice, gives you a smaller slice back, and keeps the rest. You're not getting free money. You're getting a small rebate on a fee you never even saw. Travel and rewards cards. Same mechanism as cashback, different currency. Instead of cents, you earn points or miles. These cards often come with annual fees, but they unlock things like airport lounge access, free checked bags, and free flights that somehow always have a $200 taxes and fees charge attached. The math only works in your favor if you're already spending the money anyway, and if you pay the balance in full. Carry a balance on a travel card with a 24% APR, and that free flight cost you way more than the ticket price. Balance transfer cards. This one is basically a financial life raft. These cards let you move debt from a high-interest card onto a new card with a 0% introductory APR, sometimes for 12, 15, even 21 months. The idea is simple. Stop the interest bleeding, throw every spare dollar at the actual debt while it's not growing, and get out before the promotional period ends and the real interest rate kicks back in like a trap door. Used correctly, this is one of the smartest tools in the entire credit world. Used incorrectly, meaning you transfer the debt and then just keep spending, you've basically reset the clock on a problem that's about to get worse. Business credit cards. These work almost identically to personal cards, but they're tied to a business's spending and often a business's credit profile, not just yours personally. The appeal is separation, keeping business expenses away from personal ones, plus rewards tailored to business spending categories like advertising, software, and shipping. The catch, most people don't realize, many business cards still require a personal guarantee, meaning if the business can't pay, you can. The business card is sometimes just a personal card wearing a little suit. Charge cards. This is the weird cousin in the family, most famously the classic American Express cards. A charge card has no preset spending limit, but here's the trade-off. You're required to pay the entire balance every single month. No carrying a balance, no minimum payment, no I'll deal with it later. It's basically the bank saying, we trust you completely as long as you never test that trust. Store or retail credit cards. You know this one. You're at checkout and the cashier asks if you want to save 20% today by signing up for the store card. That 20% discount is bait because retail cards often carry some of the highest interest rates of any card category, sometimes 25, 30% plus. The store doesn't care if you carry a balance. Actually, they kind of love it because the card is usually issued by a bank that's splitting profits with them. That one-time 20% discount can turn into paying way more than 20% extra over time if you don't pay it off fast. Premium or metal cards. Now the mystery cards. These come with eye-watering annual fees, $400, $500, $700 a year. So why would anyone pay that just to have a card? Two reasons. First, the perks, lounge access, hotel status, travel credits, can sometimes outweigh the fee if you actually use them. Second, and let's be honest, status. Handing someone a heavy metal card at dinner sends a message, even if that message is partially manufactured by a marketing team in a boardroom somewhere. Is it worth it? For some people, genuinely yes. For most people, it's an expensive way to feel like a main character. And now the card type the banks secretly dread. Remember how cashback and rewards cards are funded by interchange fees from merchants, not from your interest payments? That means if you take a rewards card, use it for everything, and pay the full balance every single month, every time, you are using the bank's product, getting rewarded for it, and never giving them a cent of interest. Inside the industry, people like this are sometimes called deadbeats, not because you're broke, because from the bank's perspective, you're a customer who cost them money instead of making them money. They'd rather you carry a balance. You're not doing that. You're taking the rewards and walking away clean every month. Being a financial deadbeat is, unironically, one of the best things you can be.